Between 330 and 1453 AD, the Byzantine Empire engineered nearly every legal, monetary, and organizational precondition required for a modern stock market. Yet, in over 11 centuries of continuous rule, it never actually built one. To understand why, we have to look at the empire's physical foundation. From its capital at Constantinople, Byzantine controlled the vital choke point bridging the Mediterranean trade routes and the Black Sea. The geography suggests an economy driven by merchant exchange, but research from the last 4 decades identifies Byzantine as a fiscal administrative machine. The state itself was the ultimate economic behemoth. Through its massive apparatus of tax collection, it acted as the empire's primary buyer and redistributor, dominating commercial activity and leaving little room for self-regulating markets. But this absolute state control had an unintended consequence. By suppressing free market capitalism, the imperial administration manufactured the rigid public goods, standardized law, stable currency, and financial regulation that modern capital markets require to function. The first of these foundations was poured in 309 AD, when Emperor Constantine I introduced a new gold coin, called the solidus, later known by its Greek name, the nomisma. Struck at exactly 72 pieces to the Roman pound, this coin contained 4.5 grams of virtually pure gold. That precise specification remained unaltered until the 11th century. No other pre-modern civilization maintained a standardized unit of account for 700 years. For capital markets to exist, contracts that defer payment far into the future require absolute certainty that the currency will retain its value. The nomisma eliminated the heavy premium of monetary uncertainty from long-term credit. We can see the fragility of this trust by looking at its collapse. Under Emperor Michael IV in the 1030s, the state began drastically reducing the gold content of the nomisma to finance escalating military conflicts. When later reforms finally stabilized the currency in 1092, the gold content was fixed at a permanently lower level. Monetary credibility, once compromised, rarely returns to its original peak. Long-term investment is mathematically impossible if the underlying measurement of value is constantly shifting. By holding its standard for 7 centuries, Byzantine currency provided the first required pillar of modern finance. With the currency established, the empire turned to the people who handled it. In 911 AD, the Book of the Eparch instituted Europe's earliest documented prudential regulatory regime for financial intermediaries. Money changers and bankers were subjected to strict admission requirements, asset guarantees, and direct imperial inspection. Long before modern regulatory bodies existed, Byzantium recognized that financial intermediation required centralized public oversight. Beyond regulating the bankers, the empire also codified the mathematics of their trade. In 528 AD, the legal code of Emperor Justinian I established a precise scale of maximum interest rates. This chart maps Justinian's tiered system, illustrating how the legal interest limits escalated alongside financial exposure. Rates scaled progressively, 4% for the nobility, 6% for general loans, and 8% for merchants and bankers. Notice the highest tier isolated here at the top. The law explicitly authorized a 12% return for maritime loans. This premium specifically existed to compensate investors for the extreme physical risk of losing a ship at sea. This relationship between risk and reward was further detailed in the Rhodian Sea Law, which formalized the kriokoinonia, a legal partnership that allowed passive investors and traveling merchants to share profits and mutualize their losses proportionally. By strictly supervising financial operators and legally binding the cost of capital to the level of risk, Byzantine jurisprudence constructed the conceptual DNA for modern asset valuation and insurance. We return to our initial paradox. With stable money, supervised banking, and risk-priced contracts successfully operating for centuries, why did a stock exchange never open in Constantinople? Unlike the republics that would follow it, the Byzantine state never developed tradable public debt. Instead of borrowing from citizens, the imperial treasury financed itself through aggressive taxation, hoarding massive surpluses of physical gold deep within the palace vaults. When faced with an existential military crisis and an empty treasury, emperors chose to confiscate and melt down church wealth rather than issue public bonds. Without fractional, perpetual state debt that could be legally transferred to a third party, there was simply no underlying asset to trade. A financial market requires both the legal architecture and a financial instrument. Byzantium built the architecture, but it never minted the instrument. The Byzantine institutional toolkit survived the empire's eventual decline through a series of imperial decrees known as crucibles, issued during the 11th and 12th centuries. To secure naval support, the emperors granted major tax exemptions and dedicated physical neighborhoods within Constantinople to foreign merchants from Venice, Pisa, and Genoa. These distinct foreign quarters quickly functioned as intellectual laboratories. Italian notaries living in the capital absorbed Byzantine financial law, translating and reverse engineering the empire's strict contract and banking techniques. Merchants carried these frameworks back to the Italian peninsula. There, heavily indebted city-states merged the Byzantine toolkit with their own innovation, tradable sovereign debt. The subsequent explosion of organized financial markets in places like Genoa was the direct culmination of this ancient technology transfer. The modern stock market did not emerge from a single stroke of genius. It was the result of a long, deliberate sedimentation of tools, legal and monetary frameworks forged over a millennia by Byzantine emperors, and finally put to work by the indebted merchants of the Italian republics.